There we go. We have 1, 2, 3, 4, 5, 6 consecutive bull bars in a 7-bar bull microchannel. Probably November is not going to be another bull bar. Maybe it's a bull bar, but if it is, it's going to be relatively, I think it's probably going to be a relatively weak bull bar and probably not going to close above the high of October. Weekly chart, probably going to pull back. Not a great sell signal bar. It's a small doji, but context is good. We're getting far from the moving average. Consecutive buy climaxes increases the odds that I suspect we're probably going to start to go sideways and then eventually get a pullback. We're so close to 7,000, we'll probably get there. But overall, I think we're going to 7,000, and I think we'll get back to the October 10th close. And on the daily chart, October 10th close is over here. So I think ultimately the market's probably going to get all the way back down to this price level. Bears selling, scaling, and higher. Even if we start to go sideways, we'll probably get down here. I want to see something on the euro versus the dollar. I've been saying for some time that I thought we were going to get back down to the July 30th close. Here's July 30th. We went to a new all-time high, formed a decent sell signal bar, and now we're getting a bear breakout below. We're getting a bear breakout and a second leg down from this right here. This looks strong enough to make me think that we're probably going to try and get some kind of measured move down in a test of the July 30th close. To me, that's similar to the October 10th. It's not quite the same, but if we start to go sideways for enough bars, I think we will ultimately get back down here. So we just zoom out. We're getting major higher lows, higher highs, higher lows, higher highs. We have a clear higher low here and a higher high. If this bull trend is going to end and the daily chart is going to convert into a trading range, we're going to fall below the most recent higher low, which is right here. And you'll have some bears betting they'll start selling and scaling in, betting that the bulls should not get a measured move up at this bar, which takes you to near 7,000, 7,100. It's really 7,080 is this measured move target. So overall, over the next several weeks, I think we're probably going to pull back. 5-minute chart. We gapped up on the open, and strong enough bar, we'll probably get a second leg down. We have a doji on 2. Let me just do this real quick. I'm pulling up Discord on this other computer. Anyways, 2 inside bar, probably going to get a second leg down. And then 3 bear breakout, strong enough bar. We're probably going to get a second leg down. But 1 and 2 might be the second leg. So bear breakout, we may get a pullback and then a second leg. Bull bar on 3. Good for the bulls. We may pull back for a couple of legs, but overall, I think this is probably opening and forming a trading range. We're testing the breakout point here, so probably buyers. Not a great reversal 5, not great of an entry bar 6, so we may go sideways. And then, or 5, 6, bear breakout, but a weak low 1, probably buyers below in a bounce. And then 7, a bear bar, good for the bears, but now we have a wedge. 1, 3, 7, probably buyers down here. 8, undoing. 7, good for the bulls. Probably going to go sideways to up. 9, low 1 short. Breakout, pullback, sell after 7, but probably buyers below. 10, bull bar, good for the bulls. Probably going to bounce and get a couple of legs up. And then 11, we broke to the downside and reversed up. Not a great downside break, not a great bear breakout for the bears. Increases the odds we're going to get a couple of legs up. 12, 13 consecutive bull bars, good for the bulls. 14, another bull bar, probably first reversal down, minor, and then a second leg. And then 15, 4 consecutive bull bars in a 5-bar bull macro channel. Good for the bulls. But getting relatively high in the range, I suspect traders will start selling 15, scaling in. 16, pause, and then 17, high one buy. Probably sellers above and a pullback. And then 18, we have another doji. We'll probably get at least a small second leg, but this is a warning. We're forming a trading range and going sideways below the high of bar 1. So this might just be a lower high. So it's possible we're in a bear channel, making lower highs and lower lows. We have a high, we have a lower high. We might be forming a bear channel. Bear bar 19, second entry sell. Good for the bears. Bulls, they can get out. Betting we may go sideways to down and close these breakout points. And then 20, follow through after the reversal. Not a strong follow through bar, but a close below 20, close below 19. Good for the bears. 21, bull bar, probably sellers above. And then 22, we broke to the upside. Bulls, they'll see 21 as a high 2 buy. They want a bull breakout of the bull flag and a second leg, but I suspect sellers above 19, sellers above 16, and sideways. And you can see what happened. Bears, they sold when 18 went above 19. When 22 went above 19, they sold it. Bear breakout 24 below the tight trading range. Strong enough surprise 24 will probably get at least a small second leg down. Doji 25, not a great buy for the bulls, probably going lower, and then a second leg down, crossing the moving average, still going lower. But we had a bear breakout 23, 24, pause 25, bear breakout 26. We're probably going to get a pause 27 or 28, and 27 reversal up. Good for the bulls. What about buying it? You're buying a micro channel, and we just broke below the moving average. And as strong as 27 is, it's forcing you to buy relatively in a fairly tight environment. We have a micro channel, 22 high, 27 low. There might be sellers above 27. 28, you can see what happened. We tested up to near the breakout point where the bulls got trapped, reversed down sharply on 28. 28 is enough of a surprise. I think we'll probably go lower. And then we paused 29, not a good reversal bar for the bulls. And then we got a second leg down, 30, 31, 33 outside down, good for the bears. But at this point, I suspect a trending trading range day, best case for the bears. Trading range, bear breakout, probably bulls buying and scaling in lower. Bull bar 33, not a great buy, so probably sellers above. And then we got a bear breakout 34. By 34, it's consecutive sell climaxes. We have a sell climax 30, 28, which is a bear breakout, pause 29, second leg down to 32, pause 33, third leg down 34. Climactic bar 34, probably buyers in a bounce, and we got the bounce 35. 35, 36, 37, strong enough reversal. We'll probably get a second leg up, and I suspect we'll test up to 27. But the channel down to 34 is tight, and that increases the risk that this is a minor reversal. 38 inside bar, probably going to test back to the 34 high, but we'll probably find buyers in that general area. And then we got a surprise 39. Strong enough surprise, we'll probably get a second leg down. But I suspect bulls buying 39, scaling in lower will probably make money. So if a bull buys anywhere and they put a stop, somewhere down here, they'll probably be okay. And then 40, bull bar, reversing up, good for the bulls. And then we got a second leg down on 41, 42. Consecutive bear bars, 41, 42. Probably going to get at least a small second leg down. But the bulls buying below 35 and scaling in lower probably will make money. 43, 3 consecutive bear bars, but overlap 42, 43. Makes me think there's probably buyers in this general area and the 79 low. Bull bar, 44, good for the bulls. I think always in bears, I'd get out above 44. Not a great sell for the bears. Too much risk, we're going to get a reversal. So traders can get out. And then 45, I think buyers below 45, buyers below 46, and we got the reversal of 47. And 47, I thought had a credible chance at being the low of the day. Bulls can buy above it, stop below. Betting that will probably start to go sideways to up. And then we formed a weak low 148, buyers below, and then we broke to the upside 49, but still not a great sell 49. Too much risk, we're going to rally back to the upper third of this leg. And with it being consecutive sell climaxes, we may have to test all the way up to the 37 high. We tried to break below the low 149 during 50, and we failed. Doji, 50, probably buyers in the bottom third of the bar and reversal up. Strong reversal, 51, followed through 52. I thought that changed the characteristic of the day, and we're probably always in long. So always in long, probably going higher. Doji, 53, probably buy the close for a second leg. We got the second leg up, 55, 56, 57, but now we have a breakout 55, smaller bars 56, 57. Probably going to pull back before we get a second leg. And we got the pullback 58. At this point, with the rally being as strong as it is, I suspect traders will buy any reversal down. 59, bull bar, 60, pause. It's a parabolic wedge, 53, 57, 60. But even if we get a couple of legs down, probably buyers below. And then we tried to break below 61 and we failed. Outside up 62, go for the bulls. And the bears tried to get the reversal down, 64, 65. And we broke the trend line, but the bulls immediately got the reversal up, 66. 66, enough of a surprise. We're probably going to get a second leg. I made the comment that the odds were against the bulls getting a strong follow-through bar, 67. And because of that, a lot of traders would wait to see what the follow-through bar looks like. And then 67, we have a pullback bar after 66. We have a 67, we have a reversal attempt of 66, but no one's going to sell below 67. It's a doji, not a great sell. It's okay to get out of longs below 67, and you can see what happened. The bulls prevented 67 from triggering, and they got 3 consecutive bull bars. I won by 68, but they got followed through 69, followed through 70, increased the risk we're going to go higher, and then ultimately the bulls got a strong breakout with 70 and 71. Strong enough bars will probably go a little bit higher. And then we got the small bar 72, then a bigger bar 73 was becoming climactic. And because of that, I thought the odds were against the market going a lot higher. 74, we got the bear reversal, and I thought it was a strong enough bar we'd get a second leg down. So 75, low probability buy above the high 175, probably sellers above. We got second leg down 76. Bulls tried to get the reversal up 77, but sellers in the upper third of the bar near the high 175. And then when that bar closed on its low, we ended up going a little bit lower and testing basically the bottom of the most recent leg, the 65 low at 68.75, which you can see 79 went to 68.75. So it's touched the low to the tick. Give me just 1 second. For we're stopping trades, bears, they can sell below 1. And then other than that, or really sell below 1, sell below 2. I still think it's kind of tough. And bulls, bears, I'd get out above 10. Bulls, they can buy, but not great. They can buy 13, 14, or 15, understanding that sideways is most likely. I think it's okay to get out below 19. I probably would. I would definitely get out below 23 if I was a bull. Bears, they can sell 23, they can sell 24, betting on a second leg down. 27, if you buy it, you run the risk of getting stopped out. And if you do buy it, I'd get out below 27 for sure. 28, outside down, bears will sell it, or they'll wait for follow through. 30, and then bears, if they're short, they get out above a bull bar. 35, and then they probably try and sell again. But as for the reasons I mentioned, consecutive sell climaxes, I thought that there's probably buyers in the bottom third of this leg. And some bears, they'll sell 39, hold for the betting on a second leg down. And the bears, if they're short, they get out above a bull bar. 44. Bulls, they can buy above 44. And if they get stopped out below 44, they buy again above 47. I mentioned some bulls will buy 44, get stopped out, and they'll double their position above 47. That's a reasonable thing to do. But that's one of those advanced forms of management, and most traders shouldn't do it. Bulls, bears, do they sell 45, sell 46? I would not, but if you do, I'd get out above 47. Bulls, if they buy 47, maybe they get out below 64, but if they do, arguably they got to buy again somewhere. Maybe they buy again above the high one, or the follow through high 168, follow through 69, or the follow through 70. They probably have to buy above 60, certainly above 70. Bulls, if they buy 70, they probably get out below 74 or 75. And bears, they can sell, but pretty late in the day. Limit orders, I thought probably buyers below 3, but sellers above 4. I thought buyers below 6 on 7. I thought buyers below anywhere in here. And then I thought sellers probably above 19 during 20. Sellers above 25, but it never triggered. And I thought sellers above 31. I thought buyers below 33, scaling in lower. I thought buyers below 40, scaling in lower, and they got trapped. But the bulls who bought below 40 and just scaled in, they clearly made money. I thought buyers below 44 was certainly a good trade. Buyers below 49 made sense. Buyers below 53, buyers below 57. Arguably buyers below 64, but with the channel being tight, it's probably okay. I made the comment that we might get a deep pullback. In this case, instead, we got the strong reversal up. And then as far as limit orders, that's probably it. Or buy the close, sell the close. Maybe buy the close 14 for a scalp, sell the close 24, sell the pullback, probably okay. Maybe sell the close 32, but I think tough to do. And then down here, is it sell the close 42, 43? Maybe, but I'd be more interested in buying personally. And then 52, 53, buy the close, buy the pullback. Same thing with 56, 57. And then arguably 70, 71, buy the close for a bounce. And then if you're really desperate and really aggressive, maybe sell the close 77. But most traders should I would skip that trade. Most traders should. Okay, let me take a look at questions. Okay, Brad, you mentioned a process is vital for successful trading. I wholeheartedly agree. By process, do you mean a setup or something else? Could you give me an example what you mean? Yeah. It's pretty simple. If you're going to, it's kind of like I'd ask yourself this. You have to have a trading process. And without spending an hour discussing this, you have to have some form of, you've got to have a business structure. When are you going to trade? What hours are you going to trade? Are you going to allow distractions? Are you going to allow phone calls? Basically, I'd put it to you like this. Let me just get a sip of water. Okay, so here's your homework assignment for the weekend. I want you to go start a hedge fund or start a prop firm, and you're going to go start a trading floor, and you're going to go hire 20 traders, and you're going to go, let's just say you've got someone that's going to give you $50 million to trade with on this trading floor. What's the trading process going to be? What time are you going to require your traders to go to the office? What are they going to wear? What are you going to require sleeping behaviors? If you think about what's really interesting about retail trading versus institutions is that retail traders, they just, a lot of, I mean, everybody, when they start out and they're learning how to trade, they have a goal of obviously making a lot of money from it. And they always think to themselves, oh, I'm going to make it's kind of like this side hobby. I'm going to have this hobby where one day I hope it's going to make me a lot of money. Now go look at people starting an institution, or go look at a hedge fund, and you look at their trading processes. There's hedge funds out there that actually, this is a real thing. They have risk managers, and they have people who are in charge of, really understanding. They have managers who are in charge of 10 traders, 15 traders, 20 traders, and they understand those traders really well. They know their behavior. They know how they kind of are emotionally. They know the way they act, and their job is to make sure those traders are doing okay. And again, this is speculation, but I've heard it from several people, and I believe it's true. At an institution, let's say you work for a hedge fund and you're a trader, and let's just say the trader, the risk manager, whoever's in charge, can just tell you're not behaving right. You seem kind of angry or upset, and you're just emotionally, you just don't seem the way you should be. You might get a tap. If you're that person, you may get a tap on the shoulder that day, and they say, hey, you're not going to trade today. Go home. They're not firing you, but what they're telling you politely is, hey, you're not in the right emotional, you're not in the right headspace to trade today. And therefore, I'm pulling your seat for the day. That is the level that institutions have. They have very strict processes. And one of the problems with retail traders is they just say, I'm going to trade. It's kind of like this person said, well, what is a process? Is it my trading setup? Well, yeah, it is your trading setup. So I'd ask you, what's your trading setup? Are you trading breakouts? Okay. How do you define what a breakout is? What's a breakout? What's a follow through bar? Okay. What do you need the follow through to look like? When do you know if the trade's failing? All these reasons. And the problem is, I heard a lot of people in Orlando, I thought it was really interesting. I heard people in Orlando say that one of the biggest reasons they went to Orlando was they wanted to see people like Al exit a trade that wasn't working. And they wanted to get that understanding of, when do I get out of the trade? And what I thought was very interesting is, basically what that means is they don't understand what the success or failure of the trade is. They understand that obviously if they take a trade and they're making money, it's successful, but how do they define it? They really don't understand that. I saw someone make a comment. They asked Al, and it was really, I got to talk to this person, really nice guy. But he asked Al, the person that asked the question, they said, Al, if I miss the buy, how do I know? Let's say I'm looking to buy the close of a bar. So let's say I'm looking to buy the close of 52, and I miss the buy, and then I see the reversal in 54. How do I know that that I can buy the close and hold the trade? Basically, how do I know the trade's not going to reverse? And what Al said is, you just have to buy and trust that you understand the math, and then it's going to go higher. And what that made me realize was, this person asking the question doesn't understand the math. And that's one of the biggest problems traders have. They don't really understand the trading setup that they're looking at. And because of that, they don't have a true expectation behind the trade. It's the same thing as here. Buying 51 and 52 is much different than buying 72 and 73. And you really, really have to understand that, because if you don't understand it, then that's going to increase the risk that you get some sort of pullback. So anyways, that's a long-winded answer of saying that your process includes your trading method. Every trader has a trading method or trading system. It doesn't matter if you're fully discretionary or fully, systematic. It's all the same thing. Discretionary traders, they just have a mental filing cabinet of lots of trading setups, and they just look at the market and they say, okay, I'm going to pull out my filing cabinet and I'm going to instantly trade a breakout, and here's how I'm going to enter, and here's how I'm going to manage it. They're building instantaneous rules. Okay, can you explain how trading is a zero-sum game? And can you explain why people say, or how people say trading is a zero-sum game? And in order for you to win, someone has to lose. Well, trading's always, there's different viewpoints of it. If the market's in a bull trend, there's an argument that the pie is growing and everybody's making money. And to some extent, that's true. But the reality is, I think about it like this. Most volume is done by institutions. And every year, there's institutions that are going out of business. And there's institutions being gobbled up by bigger institutions. The traders who are better than average are always going to be on top. And the traders that are elite, better than the really good traders, are going to be at the very top. And so the reality is, I don't think trading's a zero-sum game. I think there's always going to be people losing. There's always going to be losers. Now, because there's obviously market makers and there's always traders selling when you're buying and traders buying when you're selling, there's traders going to make money buying and selling. And because of that, and you can argue that there's a lot of trading going back and forth. And, when you're someone that's buying as the market's going up, well, somebody's selling as the market's going up. And when the market reverses down, they make money. So someone buying as it's going up is making money, and then they lose money right here. So I wouldn't really get too caught up in it. The biggest thing I would understand is, as the higher time frame markets continue to expand in price, traders are winning. And it's kind of like, I remember talking with a bunch of people who became financial advisors in 2008 and 2007. And there's a couple people I know that became advisors in 2007. Some people went to go work on Wall Street in 2007. And what they told me was about, all the people that wanted to do that had, a lot of them got washed out really quick within the first 6 months because of the financial crisis. And so when the market contracts for a long period of time, obviously there will be far more losers and it'll be much more of a zero-sum game. But as the market continues to climb, as it has over the past several years, then I'd say there's less losers. There's less of a zero-sum game. But overall, I wouldn't worry about it. I would just focus on you and just understand that no matter how great of a trade you think you're taking, there's at least a 20% chance that you're wrong. I would always remember that. How do you trade a parabolic move? Well, you have to understand that a parabolic move is a breakout on a higher time frame. And so what it really comes down is to understanding what the likelihood of that parabolic move is. Parabolic moves are breakouts. This is a parabolic wedge. This is a parabolic wedge. And you have to understand what is the higher time frame context. Looking at this chart, 15-minute chart, we can see we have a trading range, bear breakout, pause, second leg down, and it's a parabolic wedge. That increased the odds that this sell-off was going to be bought. So parabolic wedges are very context dependent. Okay, in your opinion, what extent does paper trading contribute to building a disciplined trading process? Is it genuinely helpful, or does it have limited real-world impact? I think paper trading has limited real-world impact. It's great. I think paper trading is great to kind of get a little bit of exposure where, you get used to placing trades, you kind of feel a little bit of excitement, and you get used to trading a platform. But I think the reality is paper trading, I have a big problem with paper trading. And one of the problems with paper trading is you don't deal with the psychological challenges that you're going to face with real money. And, it's the same thing. I won't go into it all, but anything where, I'll put it to you like this, putting $10,000 in an account, and if that's not a lot of money for you, then, pick a number that you're like, oh, that's a good amount of money. But putting some dollar amount in an account where you would not enjoy losing it, so to speak, it would feel bad if you lost it, then you're gonna deal with the psychological challenges. One of my problems with paper trading and it's all sorts of stuff. There's this mental thing of, oh, I'll just hit the reset button. It's kind of like all these. Again, I won't go into my thoughts about prop firms and all these things, but one of the challenges for me, if it's kind of like this: if you go put in $30,000 into an account and then blow it up and go lose the money, how are you going to feel? Who can tell me? How would anyone feel if you put $20,000 in an account and you over leveraged it and you lost it in a month? Would you guys keep trading, or would you stop? You'd cry. That's a good example. So let me ask you this: if you go buy one of those evaluation accounts for $50, or you go get a simulated, you just go get a paper trading account, do you really care if you lose? Not really. I mean, you'll be upset, but okay, you'll just hit the reset button. The point is, it's a lot harder to hit the reset button on a $30,000 account with money that you put in it. That'll keep you up at night. And so what it does is it exposes you to realities of trading. Someone said it would be tough to keep going if I lost 30,000, if I lost that account. And you're right, it would be. But what ends up happening, and this is my biggest problem with a lot of the way the trading world is going, is we have all these things that kind of prevent us from trading real money. And, I talked to someone, and so the biggest problem is you don't have to deal and confront the beast, which is yourself. And that's a problem when you're trading with just simulated money, or you're trading evaluation things, or whatever you want to call it. When you're not dealing with yourself and that real hard truth that, hey, you could blow this whole thing up. Like, one thing I remember Al said a couple of years ago in Orlando, he said, what's really interesting about trading is you're really one bad trade away from bankruptcy. I was like, and he said it kind of joking, but kind of serious. And what he meant was, you can it doesn't matter how much money you have, you can blow it all up. You can buy, and you can put all your money in a trading account and just leverage it. And, you can blow $5 million. People do it every day. I mean, I say every day, but people do it. And so the point with that is, I think that simulated trading it's great when you're trying to kind of better understand a trading process that you're building. But when you're really forward testing something, you got to deal with the real thing. And when it's real money on the line, when you've put money in an account, even if it's one micro, no one likes losing $50. No one likes losing $100, and it sucks. And when you make $1,000 over the course of a week, or two, pick a number, $2,000, whatever that number is that makes you feel good, and all of a sudden you lose it the following week, you got to deal with those emotions, and you got to really confront the reality of trading. So yeah, I think that simulated trading is a good way to lie to yourself. I talked a lot about that in Orlando. So if you have that presentation, you can apply it to that. All right. So overall, next week, I think we're going to get to the October 10th high over the next couple of weeks. But overall, I think we may end up having to go sideways first, and then we'll get down here. But I do think on the monthly chart, we're not going to get another bull bar on the monthly chart, but we'll see. More likely, we're going to pull back on the higher time frames. All right. Thanks, everyone. And I will talk to everybody sometime next week. Have a good weekend.